All right, well, for more market reaction and to break some of this down, let's welcome in Kevin Mahn, Hennion and Walsh Chief Investment Officer. Thank you for joining us today. Now, for those who cannot stomach all this volatility right now, you've said the best offense is a good offense is the investment strategy worth consideration. What does that look like, and how should investors be positioning their portfolios right now?
It's a great question. I don't think investors should necessarily get more conservative just because the markets are moving down, just as much as they shouldn't get more aggressive when the market is moving up. Rather, they should stay true to their risk tolerance and consistent with their longer-term financial goals. However, for those investors that have become unnerved by this market volatility or more conservative in nature, often the best offense is a good defense. And what does that mean? That employs more diversification into your portfolio, building in downside protection without abandoning the markets altogether and running to the sidelines and sitting in cash when you're earning no interest or no yield whatsoever. So identify those stocks that have a history of outperforming the market during market pullbacks, such as the one we've seen thus far in 2022. Those stocks that also pay a reasonable dividend, have strong balance sheet, and have a history of providing upside potential.
Now, obviously, a number of things moving markets. You've got the Russia-Ukraine conflict, but you also have the existing pressure about how aggressive the Fed is going to be. Now, in your notes, you highlight that the interest rate increase is just one component of the Fed's overall TNT program, tapering, narrowing, and tightening to really balance inflation with also full employment. Is there a sense of how the Fed strategy may shift with these three, given what we're now seeing as the invasion continues in Ukraine?
Yeah, I think these geopolitical tensions give the Fed some cover to perhaps not be as aggressive as some strategists earlier thought, with the potential of 8 to 9 interest rate hikes this year. It certainly takes a 50 basis point rate hike off the table for this March. In all likelihood, I believe that they're going to raise rates, according to their last dot plot chart that was released, between 5 and 6 times this year in 25 basis point increments. But as you point out, this is all just one component of their overall TNT program to help combat inflation. That being, of course, the first T, tapering, and we anticipate tapering our bond purchases ending by the end of March. The second component is N, narrowing or shrinking the size of their $8 trillion balance sheet, of which Chair Powell has told us that in all likelihood, that will begin this late spring. And then finally, the last T, tightening, raising interest rates. That's just one small component. If in fact the Fed does all three elements of that TNT program, we believe that inflationary pressures will start to moderate later this year. Of course, the sanctions that were put in place, the necessary sanctions upon Russia, will further stoke these inflationary pressures, though, specifically as it relates to energy prices.
Okay, and so, Kevin, considering the hinge on the Fed here and what they signal, we're going to hear from Fed Chair Jerome Powell later on this week on Wednesday. And if he mentions anything around the international crisis right now, given the buy the news, sell, or buy the rumor, sell the news environment that we know the adage to be in the markets, do you expect there to be some type of relief move to the upside if it sounds like that's something that the FOMC is going to take into consideration?
I think you would see a little bit of a relief flurry there, not knowing, of course, how much further these tensions, military tensions, escalate in Ukraine itself. But I do anticipate Chair Powell taking on less of a hawkish tone later this week during those hearings, and in all likelihood will refer back to being data dependent and referring back to their last released dot plot chart, which again showed roughly 5 interest rate hikes this year. Hopefully there'll be more discussion around balance sheet narrowing and also allowing some of the existing bonds to run off their balance sheet, which would further help to sustain and actually control these inflationary pressures that we're seeing without hopefully slowing down the economy too much and still hoping to promote full employment. We've seen great strides in the employment side of our economy, and that's a critical component to help ease some of these supply chain related issues that have been exacerbated by labor supply shortages over the course of the past year.
And aside from issued sanctions, is there a longer term net impact that you anticipate as businesses who previously perhaps held their nose and did business in Russia, a growing number of private sector entities now joining the public sector and cutting ties with Russian government or Russian corporate entities?
Yeah, I certainly think this will have a long-standing impact on the way that Russia is viewed within the global economy. Remembering, of course, that Russia really has a very small contribution to the global economy, with the exception of energy commodities such as crude oil and natural gas, and agricultural commodities such as wheat. We know that the U.S. actually imported between 12 million and 26 million barrels of crude oil per month from Russia last year. We also know that Europe imports roughly 25% of their crude oil from Russia and 40% of their natural gas from Russia. I think that equation does change as a result of this incident, and you could see Russia playing an even less significant role in the global economy going forward.
But at least in the near term, we have been hearing a lot about the inflationary impact and the inflationary potential of this Russia-Ukraine conflict. I'm wondering, we're already getting PCE, CPI indexes coming in at 40-year highs. How much higher do you expect these to go, and how long would you expect some of these pressures to last?
I think you're going to see a little bit of a spike upward as it relates to certainly CPI and PPI over the short term because of the energy implications of these sanctions, which again are necessary at this point. But keep in mind that the Fed does have a three-pronged approach to help combat that inflation. They don't have a magic wand that can make these inflationary pressures go away overnight, so it will take time. But we also know that the U.S. economy continues to expand. Our overall macro theme for 2022, Emily, is still growing but yet slowing. And I think that pertains to both the economy and stock market growth potential as well. Here's a great stat for all your listeners today. The S&P 500 briefly moved into correction territory last week. And over the course of history, there's only been 6 other times when the stock market has moved into correction territory this quickly. And guess what? In all 6 instances, the market was higher 6 months later by an average return of 15%. So perhaps this pullback is creating some attractive entry points that investors should consider, but of course, staying true to their risk tolerance.